Next topic we have inventory fundamentals. Why do we hold inventory? We hold inventory, Jimran walaikum assalam. We hold inventory so that whenever a customer comes, we have the goods available and we can sell them. So holding high quality inventory so that the customers do not go empty-handed. We have goods available to satisfy our customers' requirement. And at the same time, we don't want to carry too much inventory, because if you carry too much stock, this will increase your carrying cost. Carrying cost means you will have to pay a lot of rent for warehouse. You will have to employ people who will safeguard your inventory. You will have to pay a lot of insurance premium of your inventory to the insurance company. There is more likely loss by theft. More inventory will get deteriorated with the passage of time. So you have to strike a balance. Neither store too much nor store too little. Just a reasonable amount of inventory must be there. How do we establish that reasonable level of inventory? That is something you will discuss in your CMA part 2. The order size that is neither too big nor too small. So we will discuss it there and then. Now, moving on. Inventory basically is a tangible item you can touch. We hold it, either we want to sell it, you held it for resale maybe, or maybe you hold some inventory so that you can use it to produce some further goods and services. Inventory can take 4 forms. If you are a wholesaler or if you are a retailer, you will simply buy the ready-made goods and you sell it to the customers. So you buy and sell. You are not a manufacturer. Merchandiser or merchandising business basically is the wholesaler and the retailing business. You buy the finished goods, you hold them for some time, and then you sell it to your customers, right? So that's merchandising inventory. But if you are engaged in manufacturing, manufacturing business will have 3 types of inventory. First, raw material inventory, inventory that is just in the raw form. It has to be converted into the finished goods. When you start work on that raw material, some of it will be completed, 100%. This is called the finished goods. And the items that are partly completed, they are called work in process. I'm sure all of you are aware of these terminologies. Raw material used in production, work in process are partly finished goods, and the finished goods inventory means the goods that are perfectly ready for sale. Now, important point here, what are the costs do we add to the purchase price of our inventory? The cost principle requires that these items must be added to the cost of your inventory. The invoice price you paid, let's say I paid 10,000 euros to acquire certain material. I paid 2,000 freight, that is the amount incurred to bring the inventory to my warehouse, to my production facility. Maybe I had to spend 500 euros for inspection, whether the goods are up to the quality, up to the standard expected. And finally, I will have to incur some labor, and I will have to incur the ansar walaikum assalam. I will have to incur some other costs like rent, insurance, property taxes, depreciation, salary of the plant manager, plant super. In other words, all collectively called the manufacturing overhead. So all these costs added will be the cost of your product. All right. So we'll discuss these all. Just need to have the basic idea that the invoice price you pay, any freight you pay to bring the inventory to warehouse, inspection costs, and further labor and manufacturing overhead incurred to convert the inventory into its saleable form. All these are added. So let's do a question so as to get some basic understanding. An entity had the following account balances in the pre-closing trial balance. First of all, ladies and gentlemen, I always advise you people to first read the exact requirement. What do we need? The question says net purchase. We don't have to find cost of goods sold or cost of goods manufactured. We just have to find the net purchase for the period, just the cost related to purchase. So it will involve the total purchase, any transportation in, which is basically freight, any purchase discounts given by your supplier to you, any purchase allowances which are similar to purchase discounts. Maybe some goods were damaged, your supplier has reduced the price, and any goods which were not fit for your use, you return them. So just bring all these into computation. This is your gross purchase. This is the freight to be added to the purchase price. Any purchase discount and allowances needs to be deducted, and any goods which you return, all purchase is returned. So if you add all these and deduct the items marked with negative, Fraser says B, so that makes 346 to be the net purchase, right? So that makes B to be the right option. Now, let us discuss things in little finer details. When you say a merchandiser is a retailer or a wholesaler. I'm sure all of you know who wholesalers and retailers are. What they do, they purchase the merchandise, the ready-made finished goods. They hold the inventory for some time, and the inventory that is sold, it becomes cost of sale. Let me explain this concept to you. Let's say I purchase goods worth $100,000, right? And I already had some goods with me, $20,000 as opening stock. So the total goods available for sale were $120,000, right? Out of this $120,000, I have sold goods with cost of $80,000. This is what you call the cost of goods sold. The goods that have been sold, answer, the goods that have been sold, they have the cost $80,000. This is called cost of the items that I have sold. That's why it's called the cost of goods sold. You compare this cost of goods sold with the price you sold the goods at. Let's say I sold this good at $150,000 and the cost of these goods was 80. So this is my sales. This is my cost of sales. The difference between these two effectively is my gross profit, right? So this is how we calculate gross profit, comparing the sale price versus the cost of the items you sold. So this would give you the gross profit. And out of these 120 items, if 80,000 worth of goods have been sold, the remaining 40,000, this would be your ending merchandise inventory or your ending finished goods stock. So this is for the retailer or wholesaler, pretty straightforward. What about if a business is engaged in manufacturing? What a manufacturer does, manufacturer purchases raw material. Let's say I am engaged in shoe manufacturing, right? I purchase leather from Belgium, from France maybe. So all the cost involved in acquiring the leather, all the purchase cost, plus transportation, less any returns, plus any custom duty, every cost incurred to bring the raw material to my warehouse is included in the raw material cost. We just calculated net purchase. Now, those leather sheets, they cannot just convert themselves into nicely shining shoes. Someone will have to work on them. So the people who will work on them, that's direct labor. Labor directly engaged in converting the leather into finely stitched shoe. So raw material, direct labor incurred in order to convert that leather into fine shoes, and the factory overhead. When you say factory overhead, it involves all the cost incurred in your manufacturing facility. What it might include, it will include electricity of your factory, gas, telephone, water, rent, depreciation of your factory machinery, salary of your custodial staff, salary of your staff that takes care of your inventory. Maybe you have the factory kitchen where the food is cooked and the workers working in the factory, they eat at the factory canteen. That cost is also part of the factory overhead. All the costs incurred in your factory, other than material labor, it is called factory overhead. Right? So now what we do, we take in the raw material we acquired from France or from Germany or Belgium, imported leather. We incur labor and the factory overhead. This will convert raw material into a kind of inventory which is called the work in process. Work in process is partly completed goods. They are not fully ready for use. They are in process of completion. So work in process inventory means the inventory of those goods that are partly completed. All right. Once the work is completed on them, these work in process items, they become finished goods ready to be sold. Right now, let's say we manufactured goods worth $100,000 during the period. This is the value of the finished goods inventory. Now listen to me very carefully. Now out of these $100,000, we have still $20,000 available with us in our closing stock as unsold pair of shoes. The remaining $80,000 This is what you call the cost of goods sold or the cost of shoe sold. You compare this cost of goods sold with the sales revenue, and this comparison will give you the gross profit. I hope it makes sense. So whether it's a merchandiser or it's a manufacturer, you will have the cost of goods sold, and this cost of goods sold is compared with the sales revenue in order to calculate your gross profit. And after gross profit, you deduct many operating expenses like advertisement, selling, marketing, fuel, repair, maintenance, and so on and so forth. So I'm sure all of you know what it is all about. So let's see how things flow, how we add up the numbers. Let's consider for the purpose of a merchandiser who just purchases the finished goods and sells them to the customers. So let's say we have, this is important, please pay specific attention how these numbers add up to and what they mean. Let's say we have our beginning inventory of merchandise. We are a retailer. We just buy goods ready, which are perfectly ready for sale, and we sell them to our customer. So beginning inventory, $10,000. We purchased goods worth $110,000 during the period. This 110, ladies and gentlemen, it includes the freight that I will pay to bring this item to my shop or to my warehouse. Remember, purchase price of material includes the freight cost. Now, 10,000 goods were available at the beginning of the working process, 110 acquired, it means the goods available for sale are 120. Now listen, again, same dynamic. If out of these 120, $80,000 worth of goods have been sold, this is what you call the cost of sales, and what you don't sell is called ending inventory that is still with you. So ending inventory means the goods that are unsold, and this 80,000 represents cost of sales. I want to make sure you understand it well because you will require these formulas to solve some questions. Now, beginning inventory plus purchases, this is called cost of goods sold. Available for sale, that's we have calculated 10 plus 110, 120. Cost of goods available for sale or goods available for sale. And then you can write this way, goods available for sale, they're also equal to ending inventory plus cost of goods sold. Please, gentlemen, be with me. This is a fine point here. Beginning inventory plus purchases for the period, it is equal to goods available for sale. And at the same time, goods available for sale is equal to ending inventory and cost of goods sold. This very point will be explained in a question. Let me take you directly to that question so that this point is explained fully. I think it would be this. This is it. You need to find out the cost of goods available for sale. We have just learned the cost of goods available for sale can be calculated two ways. Cost of goods available for sale. It is equal to opening goods available for sale plus purchases. Either you can use this version or you can use this cost of goods available for sale is equal to ending inventory or ending stock plus cost of goods sold. Now you have these two formulas using which you can find the cost of goods available for sale. CGA for sale, cost of goods available for sale, or just goods available for sale. Now, what we do? Can we use the first version? Do we have opening stock? No. Do we have purchases? No. This means this cannot be used. You can't use this version of the formula. Then what? Cost of goods available for sale can be calculated by adding the ending stock or ending inventory, which is given right here. What we need now, just the cost of goods sold, and we will be able to solve it. So how do you find cost of goods sold? We know how to find cost of goods sold. I'm sure all of you know cost of goods sold is equal to sales minus gross profit. Please calculate the gross profit. You have everything you need. You have all the numbers. You need to calculate the gross profit. Look at the numbers given. We have been given, don't take gross sales, take net sales after returns. This is the figure for sales. How do we calculate gross profit? Gross profit is 40% of sales. So you'll write 40% of 900,000. So it's going to be, yes, you are right, absolutely. Cost shortcut, mashallah, you are absolutely right. 360 less 900,000. So this gives you cost of goods sold, which is 540. So cost of goods sold is 540. Just bring this up here. 540 is the cost of goods sold. And ending stock is 200. If you just add these two up, cost of goods sold plus ending stock, it will give you cost of goods available for sale, which is a perfect match for option C, 740. So guys, this is how you go about. Make sure whatever you're studying, it should make sense. It should make sense what we are doing with it. So coming back to what we were doing, this is it. Beginning inventory plus purchases, it is equal to cost of goods available for sale, or cost of goods available for sale is equal to ending inventory plus cost of goods sold. These interworking you should need to know. Freight, this is already added in the purchase for the period. When you acquire goods, the freight, custom duties, any cost specifically related to purchase is added to the purchase price. That is the question answered. This is what we have done. Look at this. Net purchase. Net purchase includes transportation in. Freight in is added to the cost of purchase. Okay, now moving on. Next, we have two systems you need to understand for our subsequent topics of inventory: perpetual and periodic inventory system. The meaning of perpetual is, its literal meaning is forever. Forever or for eternity. That's the literal meaning, but that we don't use the literal meanings in accounting. We have to see how it specifically relates to inventory. Perpetual inventory means inventory that is always updated. Perpetual inventory system is an inventory system that is always updated. Every sale will update your inventory. Every purchase will update your inventory. But on the other side, we have another system called periodic system, in which we don't update inventory after every transaction. We wait till the end of the period, and then at the end of the period, we see what is the closing stock. Vakas is a question. So we can see in the, yes, Vakas, now you're talking the Middle Eastern terminology. Bakala, yes, they have the perpetual inventory system, just like your large store where you buy goods, where you do your grocery. So when the items are sold, the barcode is scanned, inventory is updated. Every sale, every purchase will update the inventory record. So this is the system which you call the perpetual inventory system. And periodic system involves counting your inventory at the end of the period. Let me explain this concept further. So perpetual system of inventory means your records are always up to date. Perpetual means forever. Exactly. Right? So it provides you up-to-date cost of sales, where a cost of sales, inventory records, your gross profit can be calculated after every transaction. Whereas in periodic system of inventory, ending inventory is physically counted. You close your shutters, you close your shops, your production facility, and you count every item one by one. And this is done at the end of every quarter or maybe at the end of the year. This is called the periodic system. Let us see an example that should explain the concept in a finer detail. Let us do the same question first using perpetual, then using the periodic method. Entity A's January 1st year one inventory consists of 1,000 units with a cost of $5. Let me highlight this relevant item. 1,000 units at the cost of $5 per unit. The following are entity A's year two transactions. These are the transactions. First transaction, you sold 600 items at 4,800. Under the perpetual system, we will update our records, our inventories immediately after this transaction. What entry would be under the perpetual system? You receive 4,800 cash. There is absolutely no doubt about that. And you credit your sales with 4,800 because this is the amount involved. Now, immediately after this transaction, you will update your inventory records. You have to remove these 600 from your inventory after every transaction of purchase and sales. So what you're going to do, you're going to credit your inventory with 3,000. How 3,600 is the number of units and $5 is the cost price. So 600 times 5, 3,000 is removed from your inventory, reduction in inventory, and you debit to the cost of goods sold. At this particular transaction, you can see what is the profit and loss. This is the magic and beauty of perpetual inventory system. Every transaction for sale will reveal the profit. In this transaction alone, there is a profit of 1,800 because the cost is 3,000, the sale price is 4,800. So just on this single transaction, the profit is 1,800, and inventory records are also updated. Now, what happens on 1st of May? We purchase 250 units again at price of $5. There is no purchase account in perpetual system, we debit inventory, 250 multiplied by 5. Inventory is debited and cash is credited. See, so every transaction, sale or purchase, it directly updates your inventory record. Sale will reduce your inventory by crediting it, and purchase will increase your inventory by debiting it. So we don't have to just sit at the end of the year and physically count our stock. We just simply see our records and it will reveal us the exact amount we have in our inventory. Like we had 1,000 units in the beginning working process or beginning stock. We sold 600 units. We purchased 250 units, which means the net number of units should be 650 as per the records. And these 650 units must be present in your warehouse, in your mastauda. That's what you call warehouse in Arabic. So these 650 units are there. This is called the perpetual system of inventory. Next, in the periodic system, things are a little different. We don't update inventory after every transaction. We just wait for the end of the period, maybe end of the year or maybe end of the quarter. And at that time, we physically count and then we see what is the actual inventory available and then we determine cost of sales accordingly. Same transaction, but this time we are using periodic system. When we sell, we debit sales, cash and credit sales. That's the normal entry for the sales. Debit cash, credit sales. There is no updation of inventory. When we purchase, you debit your purchase, you credit your cash. That's what we do, right? That's what we do in the periodic system. Sales credit, purchase debit, right? And you make so many transactions, you are unable to identify from these two transactions what was the profit or loss on the transaction made. That's the problem. So your profit and loss will only be determined at the end of the period. This is how you determine your profit and cost of goods sold. Your opening stock was 1,000 into 5,000. The purchases you made were 1,250. This is it. And the ending inventory, which you physically counted there, was 32,500. Periodically, you calculated this to 3250. So opening stock plus purchase minus closing stock. This gives you cost of goods sold, and this is the entry that you now make at the end of the period. That is the problem, Bakas. So that is why there is a requirement that you should regularly audit your inventory so that any difference between your inventory, physical inventory, and the records must be investigated on time. So as you can see, the perpetual and periodic system, they show the same profits. Look at this. This is the profit, cost of goods sold versus sales, 1,800 profit. But this profit is only determined at the end of the period. Under the perpetual system, in which every transaction is made at the same time, inventory is updated. So profit and loss can be seen after every single transaction, right? So this is the difference. Nonetheless, both of you are giving the same profit. So that's the conclusion we draw. The perpetual and periodic system have the same results, same profitability. It's that under the periodic system, we wait till the end of the quarter, end of the year, whereas in perpetual system, we get updated numbers for our inventory. Now, next part. When at the end of the year, you are calculating your stock under the periodic system, and you calculate your stock to be, let's say, $950,000. These are the goods actually available in your warehouse. So the question is this all? Is this what we should consider as our closing stock or ending finished goods inventory? There are some important points you need to see. This is not always all. There are some adjustments we need to make at the end of our accounting period or at the end of the quarter, whatever the period might be. So to be accurate, in order for this number to be accurate, people, please listen. You must count all the items considered to be inventory and eliminate all items that are not. You need to add and less those items that should not be here or the items that should be here. I will explain this concept later. Now, what about the items that are in transit? You have purchased some goods and they are being delivered to you. They are in transit. Maybe you have purchased goods from Germany and they are in transit. They are coming on a ship. Now, should you add these to this number or should you deduct? Then again, you have sold some goods to a customer and those goods are with you at the moment, but the sale has already been booked. Should you remove them or not? So this is something you need to consider, whether should you add some items, whether should you deduct, so as to get the accurate number for your closing stock. Whether yes, we are going to discuss LIFO, FIFO, weighted average, and the AVCO method specific identification. All these are coming in the next lecture tomorrow, inshallah. So yes, perpetual considers LIFO, FIFO. Every transaction is matched. So that is definitely on the agenda for tomorrow. Now, what about the goods in transit? Should we add those in our stock or should we not? Now, there are two things. Goods in transit means the items are in transit. They are not available at my premises. Basically, they are on the way. So what I should do, should I add these items or should I not? You need to first see what are the shipping terms. FOB shipping point, if the goods that I have purchased or the goods I have sold, if they have been sold or purchased based upon FOB shipping point, FOB shipping, the focus must be on the shipping. It means when the goods are shipped, they are no longer the property of the seller, they are now the property of the buyer. Remember, if the term of the trade is FOB shipping, that means the legal title, the ownership of these goods pass to the buyer when the seller delivers to the goods to the carrier, to the shipper. So when the goods are shipped, at this point, the title shifts from the seller to the buyer. So the buyer must include the goods in my inventory, in his inventory. Now, let us consider we were discussing that the inventory that is in my warehouse has a value of 950. Some goods that I have ordered and they have been shipped by my supplier and they are on their way, and those goods have a value of $150,000. These goods are not physically there, but since the title has passed to me, I am the owner, goods are on their way through waterways. So I must add these $150,000 in my inventory figure because these goods are mine. I am the legal owner. Even these goods are not physically there, but they are mine. Legal title has shifted to me. So I should include it in my inventory. Then if the goods have been shipped on FOB destination, it means the goods will only be included in my inventory if they are received. Legal title, in this case, passed to the buyer when the seller delivers the goods to the specified destination. When I receive them, only then I will add in my stock amount. So FOB shipping point means as soon as goods are shipped, the ownership shifts from the seller to the buyer. And FOB destination means the ownership, the risk will transfer from seller to the buyer when the goods are delivered at destination. This very point needs to be discussed with the help of this question. Then we'll go back to the previous slide. We have a question. Yes, Vakas, it depends upon the who insured the goods. So whoever insured the goods, and if the goods are under his ownership, then he will be the one who will be compensated. Because you can only insure those goods in which you have insurable interest. For having an insurable interest, you must be the owner. Right? So FOB shipping and FOB destination, this will determine who would pay the insurance. Whoever pays the insurance will be the one who will be compensated by the insurance company. All right, so this is a good question. It says, physical inventory count showed an entity had an inventory costing $1 million. This is the value of your inventory. As per, we have one more question. Answer says, as the risk and ownership. Yes, I think you were answering to a question. Answer. So this is the number as per the goods available in my warehouse as December 31st, year one. Excluded from this amount were the following. We excluded these two amounts from the above number. Now the question that you should answer, should it have been excluded or should it have been added? We have to decide, has it been correctly excluded or it has been incorrectly excluded? Please be with me. This is a very fine question. This is the number, this is the amount of inventory at my warehouse right now. And this excludes these two. Should it be excluded? Should it not? Let us read. I am the buyer, remember, or maybe I'm the seller giving in these two different situations. Goods costing $82,000 shipped to the customer. These are the goods I have sold. Goods costing $82,000 shipped to a customer free on board FOB shipping point on December 28th, year one. They were expected to be received by the customer on January 4th, year two. Now listen to me. On 28th of December, I sold this good on this condition, FOB shipping. It means as soon as they are shipped. As soon as they are shipped, they become the property of the customer. So it must be excluded from my inventory, and it is already excluded. Why? Because FOB shipping means as soon as the goods are shipped, they are not mine. They belong to the customer. On 28th of December, the ownership transferred from me to the customer. So this figure should have been excluded, and it is actually excluded. So this is perfectly fine. I don't have to do anything with this number. This is already excluded, and it is excluded. Nothing to be done for this first transaction. What about the second one? Goods costing 122,000 shipped to a customer, free on board, destination on December 30th, year one. I also sold goods 122,000 on 30th September, FOB destination, which means when the goods are delivered at destination, only then the ownership will shift from me to the customer. On the balance sheet date, this ownership did not transfer because goods will be received by the customer on 5th January year two. Means that these are mine. These goods are mine. At the end of the year, ownership will be transferred on January 5th. So this is wrong. You should not have excluded this amount from your $1 million number. So you need to add it back. See, there is many revisions in your options given. Answer says D, then Amat says B, and then again someone says C. Answer revises his option. So C is the right answer. Because if $1 million is the value of your inventory, these goods which you have excluded, in fact, they are yours. The ownership will shift on January 5th. So you need to add these back. So means the value of your inventory must be $1.122 million. So that makes C to be the correct option. Right? Now, just one more point. Sometimes you send your goods to someone for sale. Like let's say Ansar is in UAE and I want him to be my agent. I want him to be my consignee. I transfer some goods to him so that he can sell these goods in UAE. I am the consigner. Ansar is the consignee. So in the consignment sale, there is an arrangement between me and Ansar. I am the consigner, and Ansar is consignee. I consign some goods to Ansar, and these goods are still with Ansar. He hasn't sold them. So even the goods are not with me, but they are mine. They are still with Ansar, not sold. They are not in my physical possession, but they will be considered as my inventory laying with Ansar. So remember, consigned goods are not sold, but rather transferred to an agent, Ansar, for possible sale. So when I calculate my inventory, I will add these numbers of inventory that are laying with Ansar. This is a very fine point you need to remember. And sale only when the goods are actually sold to third parties. As long as the goods are with Ansar, they are mine. Now let me explain. I have transferred goods with the cost of $100,000, and for this I had to pay $10,000 for freight. So when Ansar received these goods, they will have a cost of 110, inclusive of 10,000 transportation. So when I calculate my inventory Ansar, I'm going to add $110,000 as the value of my inventory, plus the inventory in my warehouse. So this 110 will be considered as my inventory. I will only remove this from my books when Ansar actually sells the goods and informs me accordingly. Yes, exactly, Ansar. You have transferred goods to some agent and he sells on your behalf. So you will only consider it sale when the goods are actually sold. This is fine point you need to remember. So it says goods out on consignment are included in the consignor's inventory, included in my inventory. I will remove only when the goods are actually sold. And remember, the cost I paid, the cost of transporting this $10,000 transportation cost, it is inventoriable cost. It is added as the cost of inventory. It is not a selling expense. This is a fine point you need to remember. Yes, and on every sale, Ansar will receive some commission, right? So since Ansar is just a consignee, he is not the owner. So Ansar never records the consigned good as an asset, right? Whatever he sells, he is entitled to receive some commission, but the goods with him are mine. So I will simply pay him a commission on the goods sold. Now let's see a question here. DEF is a consignee for 1,000 units of product X for ABC. Now let me mark these. ABC is a consignor and DEF is the consignee to whom the goods have been transferred. ABC should recognize the revenue from these 1,000 units. When ABC, the consignor, when should he recognize revenue? The consignor. Open question. DEF, the consignee, sells the goods and informs the consignor, sir, goods have been sold. At this point, ABC can record this as a sale. right? So this is, I hope you understood the concept. Now, a very important summary on a single table. What is included in the cost of your inventory, or what is the inventoriable cost? What is the inventoriable cost? Please be with me. This table will go a long way, maybe in tomorrow's class also. So you need to see what basically is added to the cost of your inventory, or what are the inventoriable cost. Now let's say, same example, I am a shoemaker. What are the costs that are added to the cost of shoe, or the inventoriable cost, or the cost of production? First of all, the acquisition price of material. This is what I paid to my suppliers. Please note, this $100,000 answer includes freight, it includes handling cost, it includes custom duty, it includes insurance, it includes every cost that is incurred to bring this material to my warehouse. Not just the purchase price, freight, custom duties, insurance, everything that is required to bring the material to my production facility. Now, the goods are with me. Now I incur direct labor, the workers who work directly on the machine, on the leather, to convert them into shoe, stitching and all, polishing and all that. So this would be added. Let's say it's 50,000 euros. This is the cost to be added to the cost of production, called inventoriable cost. Labor can make mistakes. They are not angels. They human make mistake. We do. We repeatedly do. So this is possible that some units, some shoe are scrapped, are damaged during production. Now, let's say every time we start work on 100 shoe, out of these, 2 invariably get damaged. That's the historical average. Out of every 100 shoe, 2 get damaged. Maybe our production system is like that. So the units that are lost, spoiled, that are expected as a part of our production system, it is called normal spoilage. So let's say if you have wasted some shoe material, some labor incurred in them, it is considered as a normal spoilage, and it is included as a part of your production cost. So please, ladies and gentlemen, it's a very fine point. Those units that are spoiled during the production process, and that spoilage was expected, wo honi thi, zaya hone hi hone the, because of our production system, this 2% average is historically there. We can't avoid this. This is unavoidable. Ye hoga hi hoga. So normal spoilage that eventually happens, inevitably happens in a production process, it is considered as a part of your production cost. On the other hand, in some months, Waqas, when you manufactured 100 shoes and you wasted 10, now this is something I'm going to be very angry about, Waqas. I'm going to take you to the book. Now, this is wrong. Out of 110 are wasted, 2, fine. This is expected. This is called the normal spoilage, or the normal loss. But these extra 8 shoes that have been wasted, they should not have been wasted. They should not have been spoiled. This is considered as an abnormal spoilage. So you cannot charge your inefficiency, you cannot charge your stupidity to the cost of production. Stupidity must never be made a cost of production. It doesn't make sense. So if you have wasted these 8 units, they must be excluded from your production cost, and they must be considered as a period cost. So this is an important point. Abnormal spoilage, unexpected spoilage that should not have happened, it is not a part of product, rather it is charged as a loss for the period. Then the next category is the variable overheads. Variable overhead means the overhead that change with the level of output. Electricity. You produce more unit, more electricity is required. You produce more unit, you need more gas, utility, natural gas. You produce more units, maybe you need more water. Then maybe it is used in the manufacturing process to clean up the leather sheets. So variable overheads, these are the overheads that vary with the level of production. They are related to production, so they are included in the production cost. Then you have FOH. FOH are overheads, but they are fixed. V stands for variable. Electricity, gas, water, indirect material, indirect labor. But then you have another category, the fixed overheads. Fixed overheads, by definition, are fixed in the short run, like rent, fixed, insurance of your factory facility, fixed, insurance of machinery, fixed, property taxes, depreciation of machinery, salary of your plant manager, plant supervisor, all the costs in the factory which are fixed come under the fixed overhead, and they are part of your product. Supervisor salary, absolutely, Vikas. Now, what about the warehousing of raw material and work in process? This is again a very fine point. When you purchase leather sheets from Germany and France and Italy and Belgium, imported leather, you have a separate warehouse where you store your raw material and work in process. So the cost of storing the raw material and the work in process, it is a part of production cost. But when the shoes are perfectly ready, shining and packed in a nice box, the cost of storing the finished goods, no, this is not the cost to be included in the part of product. This is a very fine point. So the point here is that the cost of raw material, the cost of work in process of warehousing, it is a production cost. But once the goods are made, are perfectly ready to be sent to the customers, to the sales outlet, the cost of warehousing of finished goods, it is not a production cost, it is excluded. It is considered as a selling cost. Similarly, admin and selling costs, they are not related to production, they are excluded. And the abnormal spoilage explained, they are not part of it. So please take a snapshot of the screen and save it maybe on your mobile so you know exactly what we will be adding in the part of production cost, also called the inventoriable cost, and what costs are not included as a part of product. This is something we are going to discuss in detail in our tomorrow's class. So make sure you understand these well. Now, this is the summary of inventory errors. Let me explain this idea in a more refined way. Guys, please be with me, and at the end of this part, you need to take a snapshot. Listen. At the end of the period, when you physically counted your stock, Irfan, your stock by mistake was overstated. Your closing stock was in error. You maybe miscalculated, maybe you double counted some items. Your closing stock is overstated. CS here means closing stock. Okay, now can anyone tell me, if your closing stock is overstated, how would your cost of goods sold be affected? If the closing stock is overstated, how would it affect your closing stock, cost of goods sold? Excellent. Answer understated. Now, let me explain how. We know cost of goods sold is equal to opening stock plus purchases minus closing stock. So if your closing stock is overstated, you are going to deduct a larger number from your cost of goods sold. A higher closing stock means a lower CGS. So a lower CGS means you will have more gross profit. A more gross profit means you will have a higher net income. And a higher net income means you have the higher amount in your retained earnings. Beautiful arrangement, isn't it? To the contrary, when the cost of sales, the closing stock is understated, you're going to deduct a smaller amount from here. Resultantly, your CGS is overstated, your gross profit is understated, your net profit is understated, and your retained earnings is understated. Yes, Ansar, you are right. Now, let us move on to the other side now. What about the opening stock? What if the opening stock is overstated? If the opening stock is overstated, look at this. CGS is equal to opening stock plus purchases minus closing stock. If your opening stock is overstated, you are going to add a bigger number. That means your cost of goods sold will be higher. When your cost of sale is higher, more cost, that means your gross profit would be lower. When your gross profit would be lower, your net profit would be lower, but your retained earning would be okay. Perfectly fine. There's no problem with the retained earning. Can anyone tell me why? Why your retained earnings are okay when the opening stock is overstated? Anybody? I'm going to give you $1, the one who gives the right answer.
Because it is not the part of retained earning. Only the ending stock and equity shares are the part of retained earnings.
Hashir. Net profit is a part of retained earning, whether it is high or low. Eventually, closing stock or opening stock, they will end up appearing somewhere in your net profit. So net profit, it will affect your retained earning.
The closing stock of the last year will become the opening stock. So
exactly. Excellent. Ross, you are absolutely right. So if your closing stock was overstated last year, your retained earning was overstated, right, last year. But this time, when the opening stock is overstated, your retained earning will be lowered, which actually means it will be restated to the right amount. Like, let's say last year, your retained earning was overstated by 10,000, right? And this year, because your opening stock, last year closing stock is currently your opening stock. So because of higher opening stock this year, your retained earning will be understated by 10,000. Previously, it was overstated by 10, now it's understated by 10. So this overstatement and understatement are neutralized, my friend, and the retained earnings are now perfectly fine. Same goes with if the opening stock is understated, that means your CGS is going to be understated this way. If opening stock is less, this whole amount will be less. So CGS is less. That means your gross profit would be more. That means your net profit would be more. And the same thing, your retained earning will be perfectly okay, because what happened last year, your retained earning was understated by 5,000. And this year, retained earning is overstated by 5,000. This 5,000 understatement and overstatement mean retained earning is perfectly neutralized, perfectly balanced. Absolutely right. So, gentlemen, this is the question for you. I'm going to please take a snapshot and save it as a desktop screen of your laptops or maybe the home screen of your mobiles. This will help you solve many questions. Please take a snapshot or maybe share it in our WhatsApp group. Let me know once you're done. All right. So now we have a relevant question to the situation here. Which of the following errors will result in the overstatement of net income? Overstatement of net income. Let us discuss these one by one. We are looking for the option that will result in an overstatement of net income. Let us discuss these items one by one. All right. If your beginning stock, opening stock is overstated, opening stock overstated means CGS will be overstated. That means your gross profit is understated. That means net profit is understated. So this statement is wrong. We want to see the situation where the net profit is overstated. All right. What about B? Overstatement of ending stock. Yes, this is the perfect situation here. When closing stock is higher, your CGS would be lower, and lower CGS means more gross profit and more net profit. So that makes sense. Perfectly makes sense. This is the right option. Why not C? Overstatement of goodwill amortization. Goodwill amortization is an expense. Just for this time being, it is a part of your syllabus. We will discuss within the financial reporting. For right now, consider this as an expense. So when an expense is overstated, it means your net income or net profit will be understated, not overstated. This is wrong. Then overstatement of bad debt expense. Bad debt expense again is a charge against your income statement. So when you charge more expense, it's a common sense that your net profit would be lower. So all of these A, C, and D, they are effectively reducing your net profit. It is only B that is giving you the higher profit. That makes B to be the correct option. Here we go. It's a good question. An internal auditor performs an analytical procedure to compare the gross margins of various divisional operating results. Let's say you have 5 divisions A, B, C, D, E. And all of them should have the same gross profit because the production is same. I will explain the concept. But this D happens to have 35% gross profit percentage. That's what you call the gross margin or the gross profit percentage. Now, this is a cause of concern. Internal auditor performs an analytical procedure to compare the gross margins of various divisions as shown below with those of the other divisions and with the individual divisions' performance in the previous year. So it's division versus division, current year, division versus division last year, just making a comparison. The internal auditor notes a significant increase in the gross margin at one of the divisions. Quite a high gross margin percentage, which is not usual. Rest of the division have the same 20% margin, but this division seems to have very high. The internal auditor does some preliminary investigation. Preliminary investigation means some starting investigation, not a detailed one, just rudimentary basic type of investigation. And also notes that there was no changes in products, no production method change or divisional management during the year. Everything is same in A, B, C, D, E. How come we have a very high gross profit percentage in D and not in the other? So the most likely cause of the increase in gross profit margin is anybody? Now let me explain these one by one.
C.
C. Okay, let's discuss. An increase in the number of competitors selling the similar products. There are many competitors, X, Y, Z, element. So what? Maybe thousands of customers are there. My gross margin at least should stay same. People, listen to me. If you sell 2 units or if you sell 2 million units, or maybe just 1 unit, your gross margin should be 20%. Gross margin doesn't depend upon the volume of the sale or the number of competitors. Your gross margin should be the same whether you sell 1 unit or 2 million units. So there is no justification that there are more competitors. Wrong. Your gross margin doesn't depend upon your number of competitors. Wrong. What about B? A decreasing the number of suppliers of the material used in manufacturing product. Maybe you have just few suppliers, so having less suppliers or more suppliers, it does not affect your gross margin. What affects is your cost of production. What affects is your selling price. So an overstatement of year-end inventory, that makes sense. When your closing stock is overstated, that means you're going to deduct a larger amount from CGS. Your CGS shrinks, it is understated. This shrinkage of CGS means you have more gross profit, and more gross profit means you have more net profit, and more net profit you have more retained earning, and so on and so forth. So this makes perfect sense. If in division D, there is overstatement of closing stock, this is why this division has a higher gross profit percentage than the other division. So this perfectly explains why this division has higher profitability. And what about D? An understatement of year-end account receivables. Account receivables have nothing to do with the profitability. If account receivables are lower, that means your current assets are lower. It has nothing to do with your net profit or gross profit margin. So this again is wrong. So that makes C to be the correct option. And this one we have already done.